Okay, I'm reading FDIC Deposit Insurance Regulations. Insurance on deposits was introduced into banking as a result of the Great Depression in the 1930s. Because so many banks failed during that time, deposit insurance became a critical part of restoring stability to the banking system. The Federal Deposit Insurance Act created the Federal Deposit Insurance Corporation, the FDIC, and established the limits and rules for insurance of deposits in various accounts. The Federal Savings and Loan Insurance Corporation was also created to insure deposits at thrift institutions. During the 1980s, bank failures once again began to occur at an alarming rate, and the thrift industry suffered an almost fatal blow when so many institutions failed that Congress was required to bail out the FDIC insurance fund. As a result of these events, the deposit insurance system was significantly changed in the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FDIC. This act eliminated FDIC and created two insurance funds, the Bank Insurance Fund for banking institutions and the Savings Association Insurance Fund, SAIF, for thrift institutions. Both funds were administered by FDIC with uniform deposit insurance rules. The deposit insurance regulations were also amended after passage of the FDIC Improvement Act of 1991 and the Regal Community Development and Regulatory Reform Improvement Act of 1994. The FDIC has simplified the rules several times. In 2006, the Federal Deposit Insurance Reform Act of 2005, FDIRA, was enacted, making substantive changes to deposit insurance. Its major provisions included merging BIF and SAIF into a new entity, the Deposit Insurance Fund. Second major provision, increasing insurance coverage for certain retirement accounts to $250,000. Third, allowing the FDIC to index deposit insurance coverage to the level of inflation beginning on January 1st of 2011. And last major provision was setting caps on the FDIC insurance fund to provide protection against high premiums and providing dividends to banks based on their historical contribution to the FDIC. In October of 2008, as a reaction to the crisis in the financial markets, Congress enacted the Emergency Economic Stabilization Act. This law raised the limit on deposit insurance to $250,000 until the end of 2009. In November of that year, the FDIC also issued a temporary regulation that provided unlimited deposit insurance on non-interest-bearing transaction accounts. This program was scheduled to end on June 30th of 2010, but has been extended until December 31st of 2012. The FDIC also changed the way deposit insurance is applied to mortgage interest payments and escrow balances held in mortgage servicing accounts. As of October of 2008, these balances are insured up to the standard maximum deposit insurance amount, SMDIA, for each individual mortgagor. Also, in 2008, the FDIC issued rules to determine the way in which deposits in sweep accounts are paid when an institution fails. In 2010, the FDIC issued rules to permanently extend the $250,000 deposit insurance limit. Coverage, which stuck actually. Moving on to coverage, in as per the Title 12 of the Code of Federal Regulations, Chapter 330, which is an FDIC law. The following are the general principles of insurance coverage. You have A, B, and C. A is types of covered deposits, B is exclusions, and C is the amount of coverage. A. 1. Types of covered deposits. Deposits in insurance institutions, including deposits in foreign currencies, are eligible for deposit insurance. 2. Deposits in insured branches of foreign banks that are payable to by contract in the United States are covered, except deposits to the credit of a foreign bank or its subsidiary. And third, deposit insurance is not limited to citizens and residents of the United States. B. Exclusions. 1, 2, and 3. 1. Deposits payable solely outside of the United States, the District of Columbia, Puerto Rico, Guam, and the Northern Mariana Islands, American Samoa, the Trust Territory of the Pacific Islands, or the Virgin Islands. 2 in exclusions is international banking facility time deposits, and 3rd is bank investment contracts. A bank investment contract between a bank and an employee benefit plan that expressly permits benefit responsive withdrawals or transfers will not be considered an insured deposit and will not be entitled to deposit insurance. A benefit responsive withdrawal is a withdrawal or transfer of funds during a period in which a guarantee rate is in effect, without substantial penalty or adjustment. At least 6 months interest if the deposit has a term less than 1 year, to pay benefits or allow the participant to redirect the investment. 3rd, under coverage is the amount of coverage. In general, deposits are insured up to $250,000, indexed for inflation beginning in 2011, and 2nd, non-interest-bearing transaction accounts. A. Unlimited insurance coverage until December 31st of 2012, and B. also includes interest on lawyers' trust accounts, IOLTAs. That's no longer in effect as of December 31st of 2012. That went away. General rules under the FDIC Chapter 330. Insurance coverage is based on the ownership capacities in which deposit accounts are maintained. All the interests of the same person that are held in the same ownership capacity are added together and insured up to the appropriate maximum deposit insurance amount. For example, single ownership accounts and joint ownership accounts are insured separately from each other. B. Single types recognized by FDIC, account types recognized by FDIC include 1 through 9 on this page, 503. Single accounts, joint accounts, revocable trust accounts, whether formal or informal, irrevocable trust accounts, employee benefit plan accounts, self-directed retirement accounts, corporation, partnership, and unincorporated association accounts, government accounts, non-interest-bearing transaction accounts. Are there more on page 504? No. So moving along within the general rules section, C, D, E, F, G, and H are all just different pieces of the regulation. C, accounts held by one party, such as a trustee, on behalf of another party, may be eligible for pass-through insurance provided that the FDIC's record-keeping rules are satisfied. Pass-through insurance means that the funds are held are treated for deposit insurance purposes as the funds of the principal beneficiary or true owner, as the case may be. D. Deposits in different branches of one institution are aggregated for purposes of deposit insurance. E. Deposits at separately chartered institutions are separately insured even if the institutions are affiliated. F. An account is insured for principal and interest unconditionally credited to the account plus interest accrued to the date of default of the institution. G. The death of a depositor will not affect insurance coverage for 6 months following the owner's death unless the deposit account is restructured. H. If insured institutions merge, separate insurance of deposits continues for 6 months after the date of the merger. Certificates of deposit will continue to be insured separately until the first renewal that occurs 6 months after the merger date. Rules for insured accounts. A, B, C, D, E, and these are all for, your 9 different types of accounts, I think. A is your single ownership accounts, 1 through 4. 1. All accounts owned in the name of a single natural person will be added together and insured up to the SMDIA. If more than one person has the right to withdraw funds from the account will be considered to be a joint account unless bank records clearly show that only one party is an owner. 3, accounts owned by sole proprietorships will be treated as a single ownership account. And 4, community property funds deposited into a single named account will be treated as though owned by the individual account holder. B, joint ownership accounts 1 through 4. The general rule, the interests of a person in all joint accounts in one institution are added together and insured up to the SMDIA separately from single ownership accounts. Joint accounts will qualify only if all co-owners are natural persons. Each co-owner has personally signed a signature card except for certificates of deposit. And C, each co-owner possesses withdrawal rights on the same basis. 3, the interests of the husband and wife in joint accounts made up of community property funds will be treated as joint accounts for deposit insurance purposes. 4, the interest of a person in a non-qualified joint account will be treated as a single ownership account and added to all of the other single ownership accounts of that person in the same institution, which I think means that if it's a joint account and yet only the husband signed the card and the wife didn't, what that means is that it's not considered a joint account and it's added to all of the husband's other outstanding account balances in order to determine the total SMDIA, rather than adding it to all of the account balances held by the husband and wife that may be within the bank if the wife did sign a signature card. Revocable trust accounts 1 through 10. General rule, the funds owned by an individual and deposited into revocable trust accounts will be insured up to the total of the number of different beneficiaries multiplied by the SMDIA as long as each beneficiary has an equal share of the account. Revocable trust accounts include informal trusts such as Pt1 trusts payable on death, and trust for and as trustee for accounts, and formal revocable trust accounts such as living trusts or family trusts. 3rd, the titling of the account must reflect the owner's intention that upon his or her death, the funds in the account pass directly to the named beneficiaries. For informal trusts, abbreviations such as POD, ITF, ATF are sufficient. For formal trusts, such as a living trust, family trust, or similar terms, are sufficient. Beneficiaries must be natural persons, charitable institutions, and other non-profit entities. If a non-qualifying beneficiary is named, that beneficiary's portion of the account will not be eligible for separate insurance and will be treated as single ownership accounts of each owner. Special rule for accounts with more than 5 times the SMDIA and more than 5 beneficiaries. If an account balance is greater than 5 times the SMDIA and has more than 5 beneficiaries, the insurance will be limited to the greater of 5 times the SMDIA or the aggregate amount of the interest of such beneficiary in the account, limited to the amount of the SMDIA for each beneficiary. If a revocable trust account has more than one owner, the ownership interest of each will be insured separately per beneficiary up to the amount of 5 times the SMDIA for each beneficiary. Where the owners of a revocable trust account are themselves the sole beneficiaries, the account will be insured as a joint account. For accounts held as living trusts with life estates for the beneficiaries, the FDIC will value the life estate interest as the SMDIA for deposit insurance coverage for each owner. Irrevocable trust accounts. Accounts open pursuant to written trust agreements will be separately insured up to the SMDIA for each beneficiary. The beneficiary's interest must be non-contingent. And E, accounts held by the financial institution as the trustee of an irrevocable trust. If the bank serves as a trustee of an irrevocable trust that is established pursuant to the law or written trust agreement, the funds held in the deposit account will be separately insured for each beneficiary up to the SMDIA. Accounts held on behalf of others, including agents, nominees, or fiduciaries. 1 through 5. Also have to go through corporate partnership accounts, employee benefit plans, and pass-through insurance, annuity contract accounts, accounts held by government depositors, non-interest bearing transaction accounts, and that will bring me closer to the end.